When most people think about retirement, they imagine freedom. They picture vacations, more time with family, mornings without alarms, and finally having time to enjoy life. But there is one major threat to retirement that many people underestimate, and that is taxes. And I am not just talking about income tax. The state you choose to retire in can quietly drain thousands, sometimes tens of thousands of dollars from your budget every single year through income taxes, sales taxes, property taxes, estate taxes, inheritance taxes, and other hidden costs. In other words, where you retire could have a massive impact on how long your money lasts. And that is exactly why this matters so much, because the wrong state could make retirement far more expensive than you expected, while the right state could help you keep much more of the money you spent your entire life earning. In this video, I am going to break down the most tax-friendly states for retirees, the least tax-friendly states, and the specific taxes you should pay attention to based on your own situation, because this is where many people get it wrong. They hear that a state has no income tax and assume it must be a great place to retire. But that is only one piece of the puzzle. Some states make up for low income taxes with high sales taxes, high property taxes, or taxes on estates and inheritances. So if you really want to know how retirement-friendly a state is, you have to look at the full tax picture. Let's start with the first piece of that puzzle. State income taxes. There are 8 states with no state income tax at all. That means they also do not tax capital gains at the state level. Those states are Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, and Wyoming. Now, Washington often gets grouped in with those states, but there is an important catch. Washington does tax certain long-term capital gains, so it is not exactly the same. For states that do have an income tax, the top marginal rate ranges from just 2.5% in some places all the way up to 13.3% in California. And even that number does not always tell the whole story. Some states also add extra payroll-related taxes for things like disability insurance or paid family leave. California, for example, adds around 1.1% for state disability insurance. But here is where things get more interesting. For retirees, the top income tax rate is not always the most important number. That is because some states tax earned income from working, but do not tax Social Security benefits or withdrawals from retirement accounts. So even if a state has a high tax rate on paper, your actual tax bill in retirement may be much lower than you think. And that brings us to one of the biggest retirement tax questions: Social Security. In 2025, only 9 states still tax Social Security benefits. Those states are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. And there is one important update here. West Virginia is in the process of phasing that tax out, and it is expected to be gone in 2026. Now let's go one step further. There are 13 states that do not tax pension income, 401k withdrawals, or IRA withdrawals, and that can be a huge advantage if most of your retirement income is going to come from those accounts. Those states include the 8 no-income tax states, plus Illinois, Iowa, Mississippi, Pennsylvania, and Washington. There are also 2 states that sit in a gray area, Alabama and Hawaii. They do not tax pension income, but they do tax 401k and IRA withdrawals. So this is the key takeaway. It is not enough to ask, which state has the lowest income tax? The better question is, what kind of retirement income does the state actually tax? Because that is what determines how much you will really pay. Now let's talk about capital gains taxes, because the story is similar. The same 8 no-income tax states are in that group, and Missouri joined them by eliminating state capital gains taxes starting in January 2025. But here's the catch. If a state is not collecting much through income taxes, there is a good chance it is collecting that money somewhere else. And depending on how you live, those other taxes can hit just as hard or even harder. So the real question is not just, will this state tax my income? The real question is, what will my total tax bill be in retirement? And that brings us to the next major category, sales tax. This is one of those taxes that seems small at first, but it adds up fast. If a retired couple spends around $40,000 per year on purchases that are subject to sales tax, The annual cost could be close to $4,000 depending on the state. That is real money coming out of your retirement budget every single year. 5 states have average combined sales tax rates above 9%. Those states are Louisiana, Tennessee, Arkansas, Washington, and Alabama. Tennessee is a perfect example of why you cannot judge a state by income tax alone. Tennessee does not tax earned income, which sounds great at first, but its average sales tax rate is 9.56%, and about 60% of the state's tax revenue comes from sales taxes. Even groceries are taxed there, although at a lower rate. The state sales tax is 7%, and local governments can add as much as another 2.75%, which is how the average gets so high. On the other hand, 4 states have no sales tax at all: Delaware, Montana, New Hampshire, and Oregon. Alaska also has no state-level sales tax, but local taxes there average about 1.8%. And remember, sales tax is not just about groceries or everyday shopping. Think about bigger purchases in retirement. Maybe you are replacing a vehicle. Maybe you are buying an RV. Maybe you are finally purchasing that car you always wanted. On a $50,000 vehicle, sales tax alone could add another $4,000 to $4,500 depending on where you live. That is a major difference. Now let's move to another tax that can have a huge impact in retirement, especially if you own a home: property tax. For many retirees, this becomes one of the biggest yearly expenses. According to the Census Bureau, the average American pays about $2,969 per year in property taxes. But that figure can vary dramatically depending on the state, the county, and the value of the home. And there are 2 things you need to remember here. First, property taxes are set locally, so state-level numbers are only averages. Within the same state, the actual rate can vary a lot from one county to another. Second, the home value matters just as much as the tax rate. That means a low tax rate in an expensive housing market can still produce a very large tax bill. A great example is Hawaii versus Alabama. Hawaii has the lowest property tax rate in the country, followed by Alabama, but the median home price in Hawaii is just over $800,000, while in Alabama it is under $200,000. So even though Hawaii has the lower rate, the average property tax bill there is actually almost 3 times higher than in Alabama. At the other end, the states with the highest average property tax rates are New Jersey, Illinois, Connecticut, New Hampshire, and Vermont. And when you combine tax rates with home prices, the 8 states with the lowest total property tax burden are Alabama, West Virginia, Arkansas, Louisiana, Mississippi, South Carolina, Tennessee, and Kentucky. The 8 worst states for total property taxes are New Jersey, Connecticut, New Hampshire, New York, Massachusetts, Illinois, Vermont, and California. And not surprisingly, many of those same states also rank near the top for high rental costs. Now, there is another tax issue that becomes very important for some retirees, especially those hoping to leave money or property to family members. That is estate tax and inheritance tax. These 2 are often confused, but they are not the same thing. An estate tax is taken out of the estate before heirs receive anything. An inheritance tax is paid by the person receiving the inheritance. Most people will never owe federal estate tax. Starting in 2026, the federal exemption is $15 million for individuals and $30 million for married couples. But state-level rules can still matter a lot. 5 states have inheritance taxes: Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. Those taxes can be as high as 16%. Meanwhile, 12 states plus the District of Columbia have estate taxes. Those are Connecticut, Hawaii, Illinois, Maine, Maryland, Massachusetts, Minnesota, New York, Oregon, Rhode Island, Vermont, Washington, and the District of Columbia. And each of those states has its own exemption rules and tax structure. Take Oregon, for example. In Oregon, estates over $1 million are taxed starting at 10%, and the rate can rise to 16%. So if your estate is worth $3 million there, you could be looking at an estate tax bill of around $25,000. That is not something most people want to discover too late. So when it comes to retirement taxes, here are the major categories you need to think about: income tax, Social Security tax, taxes on retirement account withdrawals, capital gains taxes, sales taxes, property taxes, estate taxes, and inheritance taxes. And yes, there are other taxes too. Excise taxes are built into products like gasoline. Some states add as little as 10 cents per gallon, while others add nearly 60 cents. Vehicle registration fees can also vary a lot from one state to another. But the taxes we have covered here are usually the ones that make the biggest difference for retirees. And the big lesson is simple. Do not focus on just one tax. Look at the entire tax picture, because one state may save you money on income tax, but cost you more in sales tax, property tax, or estate tax. And that is why choosing where to retire is not just about where you want to live. It is also about how much of your money you actually get to keep. So with that in mind, let's look at which states rank best and worst for retirees from a tax standpoint. One study ranked the most tax-friendly states for retirees based on several factors, including whether the state has no income tax, whether it exempts retirement income, and how favorable its sales, property, estate, and inheritance taxes are. 7 states came out on top. Those were Alaska, Florida, Georgia, Mississippi, Nevada, South Dakota, and Wyoming. On the other end, 7 states ranked as the least tax-friendly for retirees. Those were California, Connecticut, Maine, Minnesota, Nebraska, Rhode Island, and Vermont. Other states landed somewhere in the middle. But this is very important. These rankings are useful, but they are not personal advice. Because the best state for your retirement depends on how your income is structured and what matters most to you. For example, if you plan to do large Roth conversions over the next few years, then state income tax may matter much more during that period. A Roth conversion simply means moving money from a traditional retirement account into a Roth account, paying taxes now so future withdrawals may be tax-free. If that is part of your strategy, then the state you live in during those conversion years could make a very big difference. So there is no one-size-fits-all answer here. Every retirement plan is different. But hopefully this gives you a much clearer framework for thinking about where taxes may help or hurt you in retirement. And of course, taxes are not the only factor when choosing where to live. You may want to be close to family, you may want warm weather, you may prefer the mountains, the beach, or a lower cost of living. All of those things matter too, but taxes absolutely play a major role. Because at the end of the day, retirement is not just about how much money you have, it is also about how much of that money you actually get to keep. If you found this video helpful, make sure to subscribe to Bridgeport Finance channel, like the video, share it with someone else planning for retirement, and let me know in the comments which state you think is the most retirement friendly. Thanks for watching and see you in the next video.